This week on the Retirement Quick Tips podcast, I'm talking about longevity risk, which is the risk that you will outlive your savings because you lived too long in retirement. Today, I'm talking about maintaining a tilt towards growth in your investment portfolio to combat longevity risk. So if you retired 10 years ago and you decided at that time that you wanted to protect your portfolio from all outside shocks, stock market, you're going to have to build a portfolio that's going to have bonds and cash and no stocks, and you would be fully insulated from whatever would come in the stock market. Well, you would have built a bond portfolio that provided terrible returns over the last 10 years. Interest rates were historically low in the 2010s, basically all the way up until 2022 when the Fed started raising interest rates. I remember money markets, which are paying over 4% today, were paying next to nothing. It was like maybe 0.25% or something like that. And for a really long time too. Interest rates were very, very, very low for a really long time. And the U.S. Aggregate Bond Index, which is a benchmark of the overall U.S. bond market, over that last 10-year time period, averaged a return of 1.3% per year. Inflation was higher than that. Plus, you had to pay taxes on the interest or withdrawals. So if you're pulling money out, if it's in a taxable account, you're paying interest on that bond income generally, unless you have municipal bonds. And if it's in a retirement account, like an IRA or a 401k, those withdrawals, you pay taxes on those withdrawals. So when you couple that with a low 1.3% return, the fact that inflation was higher than that, we got to deal with the taxes too. You're coming out way behind. And investing in such a low return asset class and then starting withdrawals, what happens is it doesn't take long before you start seeing the principal value of your investments decline. And it starts this spiral of doom because the low returns coupled with the higher inflation means that you're going to need to continue to increase your withdrawal amount even more beyond what your ultra conservative portfolio can provide as income. And the decline in value really starts to accelerate if you do not cut back significantly on your withdrawals and change your investment strategy as well, which most people, they just dig their heels in. They've already suffered the consequences of a low return portfolio, and they do not want to go back to stocks. They feel like as soon as they go back into stocks and reposition their portfolio, it's going to drop 40%. They're going to be even worse off. So they get this paralysis by analysis, I can't do it. I'm not going to go back. And it really ends up biting them. I've had some employees in the 401k plans that I work with do this. Thankfully, I don't have really any clients who are 100% in bonds because they're scared that the sky is falling. But bonds and cash, I don't want to convey the idea that you shouldn't invest in these areas. You should actually. They play a vital role because they provide stability and generate income. But we need balance. A balanced portfolio of 50 to 60% stocks would have fared much better over the last 10 years. It would have kept pace with inflation and taxes and hopefully your withdrawals too if you were retired over the last 10 years. A typical balanced portfolio has a 60-40 portfolio, 60% stocks, 40% in bonds. That would have earned around 7% a year over the last 10 years, compared to, again, the 1.3% that you earned in bonds only. So to help combat longevity risk, you want to maintain diversification and a allocation to stocks and bonds that is consistent with your stage in life. So we don't want to go ultra conservative in this misguided attempt to protect what you have saved, because in the long run, you're not protecting anything. That strategy is going to backfire unless you have so much money that your withdrawal rate is so low and a 1.3% return is no big deal because you're needing less than half of that or much less than that. Because again, it's not just about the returns. It's about what income is being generated. How am I going to increase my cost of living? What are the taxes? These are all things that eat into the net money that you're able to withdraw from your portfolio. So to protect yourself, you also want to be very careful, especially right now, of having any concentrations. Even owning a significant chunk of your portfolio in the, I use air quotes, diversified S&P 500 index fund, that is actually a concentrated bet right now. If you have large positions also in specific stocks, You may need to start offloading those concentrated holdings, sell large chunks of that S&P 500 index fund that is way more concentrated than you might realize. I like 60% in stocks for most people, especially if you're well diversified at the outset of retirement, since it balances continued growth with protection on the downside. Because 40% of your portfolio in that case is still in the very stable bonds and cash asset class. As long as you're diversified within that 60-40 allocation and your portfolio is generating stable and sustainable income through dividends and interest, like we want reliable income. And that's what bonds and even dividend stocks can provide that as well. And that should help protect you from longevity risk with an improperly positioned portfolio. Longevity risk really takes hold when you're making 1.3% a year and you still need to withdraw 3 or 4% or even more than that. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.